Tesla stock was up 2.63% in regular trading, up another 0.3% in after hours. So cumulatively up almost 3% on the day today. That is quite the bounce back considering Friday you were down almost 9%. Well, what's coming next for markets, for Tesla and your portfolios? Apparently there is a leak that we can expect here soon, whether or not the Fed decides to go with 25 or 50 basis points at the next Fed meeting. According to Deutsche Bank, this is their note out today. They say if the Fed decided on 50 basis points, Powell will leak it through, quote, well-informed press contacts. Keep an eye on Nikki leaks over the next few days. Should be cemented after CPI comes out Wednesday. So after CPI comes out Wednesday, that's when we should expect a final verdict from Nick Timmerhouse's X account and the Wall Street Journal. Current probabilities are 30% for a 50 basis point cut and 70% chance for a 25 basis point cut. I think it really comes down to how weak CPI is. For an example, let's say CPI comes in really low on Wednesday, then the Fed's probably going to opt for a 50 basis point cut because you don't want to see the economy weakening, inflation coming in too low. That is a big problem because inflation, believe it or not, is really a sign of economic activity and strength of the consumer. If you have high inflation, consumers doing well. Companies are passing on cost and consumers are paying them, hence inflation. If inflation starts to come in on the low side, which it has been in recent months, you start to get questions about economic activity, the strength of the consumer, and companies' pricing power. You can see some of China's deflationary pressures that, quote, are now entering a dangerous new stage, according to Bloomberg, because this is the longest decline of prices in the country since 1999, when there was a pretty deep recession. And if you continue to see this kind of deflationary pressures, the Chinese economy is going to get even worse and potentially have a spillover effect to the broader economy, to the world economy. JP Morgan says, quote, China's ongoing deflation raises questions about its potential spillover to the rest of the world. Data through July showed China's export prices falling at a faster pace of negative 6.9% year over year, with the subsequential 3% 3-month rate dipping back into negative territory. And I know a lot of people are not going to understand this, but inflation is better than deflation. In other words, deflation is worse for the economy than inflation. And I know it sounds great, right? If your grocery bills go down $50 a week, $20 a week, that sounds great, but it's actually not. And you shouldn't hope that happens. Because in that kind of environment, take for an example, this nature-made vitamin C chewables. They're actually delicious, and I eat them too much. 1,000 milligrams, a supplement, okay? Or this bottle of hot sauce that I just conveniently have on the work desk. These things, if they start to go down in price, that means companies have to cut price because people are not buying as many of them and they cannot raise prices. And that means, well, Nature Made is going to take in less revenue. That means Melinda's fire roasted garlic and habanero hot sauce is going to take in less revenue. So what does that mean? They start to fire employees, and then those employees can't buy anything anymore. And then those businesses that those employees shopped at are worse off. And it's a big trickle over disaster when you get deflation that starts. So the Fed doesn't want deflation. And if it looks like we are on a trajectory towards deflation, that's going to be an even bigger problem for the Fed than inflation. And that would mean the money printers are going to go back on again. First step to that would be a 50 basis point cut from the Fed, but I don't think that would be a positive for markets. I really don't think any cut from the Fed is going to be seen as a positive by the markets because it is coming with a weakening economy. The economy is not super strong anymore. The economy is definitively weakening or slowing down. And until the markets know for sure there's no recession, that we're going to have a soft landing, I don't think the first cut from the Fed is going to be positive. And in fact, I don't think we'll know if we're actually going to get a soft landing until we have multiple cuts from the Fed in the bag. In my opinion, at least a neutral. That's when we can definitively say, like, this was a soft landing. The Fed did their job. They accomplished exactly what they wanted to do. But at this point, you can't be too confident that's the direction we're headed in. Now, whether or not we go into recession is one thing. As I've talked about many times here on this channel, what do you think the odds of a recession actually are? I know the bulls are going to say like 10%, 20%. That's great. Let's use the bulls here as context. Because what do you think the markets are pricing in as far as a percentage chance of a recession over the next 12 months? If you said anything besides 0, you're wrong. It's a 0% chance of a recession. I don't even think the biggest bulls out there would say there's a 0% chance of a recession. Hopefully they're not managing people's money if that's, what they would say. So we do need to price in some recession risk. The question is how much, and how much downside does that lead to in markets? I don't think this 4% last week price action decline in the S&P is sufficient to price in a 10, 20, 30, 40% chance of a recession. I think you need to fall maybe a lot more before that happens. And the election is right around the corner. So I do think having some cash on the sidelines is probably the best idea here. As you can see here, a higher tax rate of 28% versus the 21% that we have now for the corporate tax rate is estimated to be a 5% hit to EPS coming next year. So theoretically, just to price in what that would mean for markets would be lower EPS estimates. I mean, stocks are trading at all-time highs because of the EPS estimates being at all-time highs. And could you get downside in the markets based on this? Absolutely. Now, the Trump tariffs would also have a negative impact to the economy, at least initially. It's unclear how much that would impact S&P 500 EPS, though, at this point. Things are not all bad. Let's be honest. We did get a surge in consumer credit in late trading today. Now, this is the reason why markets took off towards the end of the trading day today. And you can look at this from the perspective of the glass is half empty approach or the glass is half full approach. Because on one hand, consumers, they spent $25.45 billion last month. But that's how much they went into debt, right? That's the amount of debt that was accumulated in the last month. By far a 12-month high. This is, the biggest 1-month surge you have seen in a long time. Okay, going back to 2021, right? This surge here, it's the biggest 1-month surge that you have seen in almost 3 years now. But it's all debt. So how strong is this economy really? It's hard to say, but people are still spending money, even if they're going into debt. Okay, now it says here the total consumer credit in the U.S. surged by $25.45 billion in July of 2024, significantly higher than the $12.5 billion increase expected by the markets. So this was double what the markets were expecting, and well above the downwardly revised $5.23 billion rise in June. This marked the largest credit growth since November of 2022. So based on last month's revision. It says driven by substantial increases in both revolving and non-revolving debt. Revolving credit, which includes credit card balances, climbed by $10.6 billion, the biggest jump in 5 months. Meanwhile, non-revolving credit, covering loans for vehicles and education, surged by $14.8 billion. This sharp rise in consumer borrowing signals strong demand for credit despite ongoing economic uncertainties. And really, in this market environment with a 4% downside move in the S&P last week alone, heading into the first cut by the Fed, where Wall Street's just trying to figure out how bad is the economy, how bad are things going to get? Are we going into recession? Is the Fed cutting because they're too late, or are they just trying to normalize policy? There's a lot of uncertainties out there just surrounding the economy and the Fed, let alone the election, let alone what the corporate tax rate will be, tariffs, or anything else that we will unpack here in the coming months. Any data that's seen as remotely positive, even if you got to look at it in the glass is half full approach, like people spending money, but it's just debt, right, is seen as good news. I take this data with a grain of salt because I don't know if going into debt to spend money is a great idea when credit card delinquencies are at almost 20-year highs, but markets like it. So don't fight the markets on that one. Tomorrow, we are going to get the NFIB Business Optimism Index. We are expecting that to fall a little bit. If it falls, not good. If it goes up, that's good. It's pretty simple. Good news is good news. Bad news is bad news these days. We also have a 42-day bond auction and a 3-year bond auction. I think the 3-year bond auction could be interesting considering the recent drop in 10-year treasury yields and the expectation that the Fed's going to be cutting rates a lot over just the next 12 months. In fact, here, according to Bar Chart, traders expect the Federal Reserve to cut interest rates by roughly 240 basis points over the next 12 months. So that would put the federal funds rate around 2.85%, give or take, 12 months from now. I don't know if we can price in that many cuts that quickly and not price in any further recession risk. That is one hell of a normalizing cycle. Dean Christians on X says, I'm surprised more people are not talking about the potential Head and Shoulders top forming in semiconductors. And that is definitely what it looks like to me. EJ Antoni said wholesalers are doing less business today in terms of actual stuff being sold, but today's higher prices make it look like sales are increasing. Instead, retail sales are down 6.3% since March of 2022. Nearly all of the 23.8% increase since January of 2021 has just been inflation. So you're spending more, but getting less. Kind of what we already knew. EJ Antoni also says huge increase in consumer credit in July, with revolving credit jumping 9.4% annualized rate, while the last several months were all revised up. The show goes on, even if it means more people falling deeper into credit card debt. But if we actually put this into historical context, it says revolving consumer credit jumped by an annualized 9.4% in July. Definitely a big gain relative to the prior month's 0.3% decline, but not wild relative to history. Relative to history, this is kind of average. I think part of the problem is now there's just so much debt out there that these increases are huge, right? 9.4% increase is way bigger today than it was in the 80s when credit card change was like 40%, right? Because there's a lot more cards today. There's a lot more debt today. So this 9.4% increase is actually pretty big. So what does this mean for Tesla stock? I think it's pretty obvious. What we've seen today was Tesla outperform the markets. And I think Tesla will outperform the markets on good days. And if we get more data that suggests there's potentially a soft landing coming, that's good news. Now, today's data was minor in relation to the jobs report, consumer spending or anything, retail sales or durable goods orders, anything that has to do with the consumer actually spending money. Like this data today was very small. You had wholesale inventories and this consumer credit report. That was it. I don't think you want to draw any conclusions here that we have the soft landing and markets are going to do exceptionally well. I think the Friday jobs report that we got was not good. Not good enough. We were expecting something decisively positive. We did not get that. We got something that was really more negative than positive. We missed 20,000 on the headline report. Unemployment rate dropped from 4.26% down to 4.22%. It wasn't decisively positive. Okay, it was actually net negative in my personal opinion. Based on where expectations were. So I think that's still going to affect our markets. I do think throughout the rest of, this week, markets could do okay. Next week is when things get pretty crazy with the first cut from the Fed. I should also mention this week on Wednesday, we do have Jensen Huang that will speak at the Goldman conference that they do every year with tech CEOs. That may move our markets, might move Nvidia. That could be important, but who knows? Bottom line is, I want to have a lot of cash on the sidelines right now. I know what the risks are. The only positive upside surprises I see from here in equities comes from good economic data. We won't get any good economic data or really any important economic data for the rest of this week. So we could have a decent week this week, but next week with the Fed cutting rates, I don't know if that's going to be the whole huge bullish catalyst that we've forecasted for 2 years now. Everyone's been looking forward to the first cut. In fact, the first cut is typically when you want to sell that event, when you actually want to be in cash. Doesn't have to play out that way, but that's just what history suggests. And I do think October is not going to be a great month either. Because, one, if markets sell the first Fed cut, that's not great. But then you're going to price in election uncertainties, election risk, and either way that thing goes, there's negative implications for the economy. So I do think you will get a better buying opportunity on Tesla, on broader markets, on, certain areas. Even consumer discretionaries. Those areas have done really bad. If that's an area, that could potentially have some opportunities. Consumer discretionary is the number one biggest beneficiary of the Fed cutting rates. Historically speaking, consumer discretionaries tend to do the best after the first Fed cut. So if you're bullish on markets, that's probably the area to look at. Tesla could fit in that category. Interest rate sensitives could fit in that category. High-paying dividend stocks could fit in that category, as money market funds are going to start being reduced after the Fed does lower rates. So from that standpoint, you can go shopping in certain areas if you want to, but I do think we're going to get, generally speaking, better buying opportunities over the next couple of weeks. And, Nikki Leaks on Wednesday, I'm expecting to hear something pretty much straight from Fed Jerome Powell. 25 basis points or 50. If it's looking like 50, that could be an even harsher reaction by the markets. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.